If you have been in this market, the stock market, for some time, you realize that money does not leave or disappears from the stock market. It only rotates from one place to another place. Now, you see, after the Monetary Policy Committee meeting, they actually maintained the interest rate at 26.5%. To most people, that is a very high interest rate because it affects how the banks will actually lend to their customers. Now, if you believe that the interest rate of 26.5 is high, now since our monetary policy says it is 26.5%, there are also opportunities to make money when the interest rate is high. Now, welcome to Clockwise. My name is Providence, and my guest is here. The one that sleeps on the chart, yes, is always on the fundamentals of this company, following the policies of this company and that of the government, and he's here to point out 5 investments that you can actually make profit at this point. With a resounding virtual round of applause, welcome, Mr. Kane. Welcome to Clockwise.
Thank you very much for having me.
Yes, let's just move straight to business as usual. You see, after the last MPC meeting, people were expecting that there will be a reduction in interest rates because it actually affects how banks actually lend money to their customers. But the central bank decided to maintain its interest rate at 26.5%. They gave their reasons. Now, before we dive into today's conversation, what reasons do you think? Are the reasons strong enough?
Okay, so let me modify something you said. You said it affects how banks. No, it doesn't affect. It doesn't only affect. Interest rate affects everything.
Everything
you buy, the price of anything you buy is affected by interest rates.
But it majorly affects how banks lend money to their customers.
So yeah, it is true. Monday and Tuesday, the MPC met in Abuja and decided to leave rates unchanged at 26.5%. There is no way it was supposed to be a downward trajectory for the interest rates, but there is no way a sane MPC can be thinking of cutting interest rates when the tumult in the Middle East is still ongoing. Okay. Now we saw Brent went below 60. Now it's back above 82. So because hostilities have resumed between US and Iran. So there is just no way, and of course we expect a long dragged conflict, which means you might see oil prices remain stubbornly high. In that, and of course, Nigeria is a fuel-based economy. That means we expect it to begin to show up in the consumer price index, which is the CPI. Currently, it stands it just came down. And the reason why some people said, like you met in the intro, some people thought about it was because for June, the inflation, the CPI came down from 15.93 to 15.91. Okay. About 200 basis points. 20 basis points. Yeah. In fact, should I even say 20 basis points?
19.
No, essentially 2 basis points actually. From what we had before. So essentially what you have here is the inflation just eased a little bit, just a little bit. And then that is not enough reason for the MPC to think of modifying rates because, again, like I told you, the MPC doesn't really look at the current, because when you have in July you are reporting a past event. Yeah. The CPI as of June. Sorry, in July you are reporting a CPI as of June. The MPC works with what we call inflation expectation. So you project what would be inflation be by year end. So you start, because these things have what we call long and variable lags. What you do today might not present itself immediately. It takes some time to walk through the economy. So whatever rate decision is made does not have immediate impact. Yeah, it might have in terms of the stock market, because the stock market always look ahead, but it will not have immediately in terms of the prices on the shelves. It takes time, what we call long and variable lags. There's that lag between the time of the rate decision, and when it has to walk through the economy. So essentially, the reason why the CBN's MPC decided to leave rates unchanged at 26.5 was because of the of the inflation expectation due to the crisis in the Middle East. Not only that, even the cash reserve ratio was still left at 45%, which means the bank is still looking at interest-based risk. That's why they decided to leave the cash reserve ratio at 45%.
Okay, those are very strong points. Yeah, very strong. If you look at it very, very well. But you see, we've always said that there is always an opportunity in every policy to make money, because the money does not leave the markets. The money only rotates to different locations, different assets. So today we'll be discussing 5 investments that you feel or that you know will benefit so much with this particular policy.
Okay.
And investors can actually take advantage of.
Okay. So we're going to take time to really look at those. It's the sector that benefits the most from in a high interest environment is the banking sector.
Okay.
Because the banks are primed. In fact, they are well situated to make the most money.
Okay, this is their time.
This is their time to make money.
Yeah.
If you cannot make money at this time, then I don't know what. Though we've seen, First Bank just released its earnings. We saw a very serious uptick in terms of non-interest income.
They came from behind. I don't know how.
I'm telling you, so it was explosive. If you look at profit before tax, it was up 83% for half year 2026. 83%. That's the increase. That's a remarkable increase in terms of profit before tax. But the point I'm really looking at is that even non-interest income was high. But again, interest income is almost always a behemoth. Now, because in a high interest rate environment, banks can lend. Yeah. They can lend money to government. They can buy government securities. Think about it this way. The Naira has appreciated against the dollar in very good terms over the past several months or thereabouts. Yeah. Now, remember, the federal funds rate is still at 3.5 to 3.75%. The Fed did not change the rates. Now, what that tells you is that there's something called an arbitrage. You can take advantage of the arbitrage. Imagine borrowing US dollars at 3.5. Call it, if the federal funds rate is 3 points, I would call it by, let's say it's 4% really. So even if you borrow at 4% and then you come to Nigeria and make a ton of money by investing and getting 26 point. Almost 27%. Do you know what that is? Even if you put it in T-bills, if you put it in bonds, that is giving you 22%, 23%. Do you understand? The arbitrage is already 18%. So you are making 18% from that arbitrage. And guess who is most positioned? The people that are most positioned, they're banks. So banks benefit a lot from high interest rate environment. That's just one side. Yeah. The other side is the arbitrage. A customer comes in to deposit. Customer deposit, how much do they pay in interest? Even high interest accounts, about 3% now, between 3 and 5%. This Naira to Naira. So even the FX, the other side was introducing FX, so you borrow in dollars and invest in Naira. Good. But look at the one that has no FX risk at all. They mobilize deposits. People come in and deposit. When they deposit, the bank takes that deposit, pays them how much? 3% at the higher. I know some accounts that are even doing less than 1%. So, but even if it's a fixed deposit, the bank does 3%, 3 to 5%. Some banks try to do 8%. But the average is about 5%. Yeah. So you have the bank takes the money at 5%. So, and then they loan, then they buy, even if they buy government securities at 21%. That is the net interest margin now.
It's so large.
The net interest margin is 16%. 16%. That's what they take. So the banks are primed. That's why, in fact, now they just look at the reports that will be showing up. We saw for First Holdco, we're expecting more to report. What you expect to see would be net interest margins will be so large, because of the high interest rate environment they are. Then the final thing you should note, especially among the banks, is the banks look at the cash reserve ratio that they have. They have is 45%. 55% is available for them to use. And most banks, how much do they even lend to the real sector? Some banks don't even lend, or in their portfolio, they don't even have up to 10% that they lend to the real sector. Yes, you would say the real sector is risky. You will now begin to cite the likes of Access Bank that racked up as much as 523 billion in payment charge. But the reality is, look at 55%. And let's say they even loaned as much as 10% to the real sector. Then that means they have about another 45% that they really use to make those. So they invest a lot, banks invest a lot and benefit from the insane arbitrage in terms of how much they are paying to depositors and how much they are getting from, even if they are doing fixed deposit. Now, the banks also participate even in what we call commercial papers. Commercial papers are, kind of bonds. Let me use a term that people will understand. Bonds issued by corporates. So a corporate wants to raise funds through the debt market, not the capital market, not by selling equities, but by debt. So the corporate issues a commercial paper. Banks invest in those commercial papers. And remember, if government securities, which is, by the way, essentially risk-free, gives you 21%, guess what? You cannot, there's something called premium, risk premium. Risk premium means how much are you paying me for going away from the government that is risk-free and coming to invest in you. So you're looking at something around 25 to 30% or even more for the commercial papers. So the banks actually do a weighted kind of exposure to both government securities, which, by the way, is still very high because it tracks it tracks the monetary policy rate, and then they balance that with commercial papers, which allows them to have a higher Sharpe ratio even in their fixed income portfolio. So banks banks I just mentioned sectorally. Now, which names am I specifically looking at? The first name would be the name that knows how to, in terms of balance sheet integrity, in terms of loan discipline. Because remember, you can make so much, you have to understand where to apply the resources in order to make money. And there's no other name than Zenith Bank. Because remember, if you lean too much into one sector and that sector doesn't perform well in terms of interest income, then you end up racking up impairment charge. And what is impairment charge? Impairment charge is an amount that you set aside to account for non-performing loans. So, for example, let's say I lent somebody, let's say, 10,000 naira. Now, the person has not paid back, but I'm making effort to pay the person back. But for accounting reason, I just say, you know what, let me take that 10,000 as an amount that I have lost. Okay. Is it possible for me to recoup it? Yes. But just for the books to be a bit more comprehensible, I just put that away as that's in payment charge. So Zenith Bank understands how to balance risk a lot. So what that means is that they know where to gain exposure in order to ensure that they don't rack up in payment charges. That's why you see their loan book is very excellent. So Zenith Bank is number one. That I will mention. In fact, that's why recently, if you saw the brokers actually came up with some names that they recommended names for investors to take a look at. There was only one bank, one institution, one stock that had consensus. So all four of the brokers actually recommended Zenith Bank as a buy because of that loan discipline, because of excellent balance sheet, because of their how they can expand their net interest margin and all of those things. So Zenith Bank is, for me, the number one. The next one is going to be the GTCO, and the reason is because remember what I just told you just now. that arbitrage. GTCO has foreign subsidiaries. What that means is that it can earn a lot in US dollars. And guess what? What is the interest on the US dollar? The rate is 3.5%. Now, if it is 3.55% and you have an economy where you can actually get 25%, or even depending, or even 30% if you are doing commercial papers, then the arbitrage becomes yawning. So that means they have, when you talk about that currency or interest rate arbitrage, GT is sitting at the nexus. You can earn in US dollars. You can earn in US dollars. You can attract, revenue. You can attract deposit in US dollars. You can attract funds in US dollars, and then use our local rate to really amplify your returns. That's why GTCO is. And by the way, it's a very excellently run bank. You'll agree with me. So they have a way of benefiting from the fact that in terms of liquidity, FX liquidity, they are there. And in terms of willing that if it is even necessary for us to repay debt, because again, there's something called carry trade. The carry trade is this. Like I just told you about that arbitrage. You borrow in US dollars at 3.5%. Or maybe 4 or 5%, and then you invest in naira. Most of when I told you that 10 billion came into Nigeria in investments, and over 9.5 billion went into the fixed income market. What do you think they were doing? It is basically what? It's basically a carry trade and arbitrage. So what they basically do is they borrow in US dollars, pay maybe 5% in interest, come to Nigeria, and then invest in buying government securities and get as much as 22%. So the arbitrage they are enjoying now becomes 17%. That's the reason. That's why you saw that's why we call them hot money. Those money don't last, because the moment it looks as if that arbitrage is shrinking. Meaning, for example, if the CBN's MPC begins to think about lowering rates, so that means that arbitrage begins to shrink. Once it shrinks, they have to take it back, because again, by doing that, you are also, in reality, you are also taking some FX risk. Because what if naira falls such that it falls so much so that the arbitrage, even when you are getting 17%, if naira has fallen by almost an equivalent amount, you are really not getting anything, or you are probably even losing money. So that is just the reality. And that's why GT Bank sits at a very comfortable spot in that regard. Then, of course, the last one I will mention in terms of the banks, I'm capturing 3 names in banks, and then the 2 others will be from other industries. Because banks, actually, if I'm to actually play this trade, the interest rate trade, I'll literally deposit 45% of my investment in banks, or even not 50%. So now, watch this. The next one I will talk about is Access Bank. And here is why I'm talking about Access Bank. I know there are other names in the focus. But Access Bank, remember, the more you have to lend, guess what? The more you make. Access Bank is the largest bank in Africa, or the largest bank in Nigeria, in terms of assets and deposits. So that means they have more to lend out, or possibly more to even sell to the government, or take advantage of the interest rate environment. That's why if you observe, if you look at the chart, you see that Access Bank has started picking. It's this month it's got 26.5. I was here screaming for people to buy at 21.9%. I made a buy.
Call it a penny stock.
You called it. So you see, we even have a non-believer, unbeliever here.
No. You did not at that time.
He did not believe in Access Bank at all. You did not believe in Access Bank.
The books were so wrong.
No, what was wrong in the books?
The books were so wrong.
The impairment charge, yes, I know. The impairment charge was insane. But what shocked you? I also told you that look at the interest margin. Look at their net interest margin. Look at their interest income. Which was huge, was very, quite huge. And I also told you that Q1, they have not reported yet, but I'm just telling you, Q1, if something moved from an average of 130 billion per quarter impairment charge to 79 billion, that is a very significant, because first quarter was 79 billion naira in impairment charge. That's an improvement If you look at it, that's a very significant improvement. And I told that over time, they will have a way of really recouping some of those bad debts. So that's why for me, Access Bank, it sits 52 trillion naira. That allows them to make more, make more from, because again, if you look at it, in terms of growth, in terms of growth in terms of earnings per share of this, most of the forecast is negative. So you look at, definitely, if you are going to make a choice, you have to look at some other numbers. And in terms of this, especially with what we are talking about, in terms of this high interest rate environment, who has loan discipline and who has a fat balance sheet, a fat asset base, is most likely going to benefit very, very seriously.
The more money you have, the more you can.
So the more money you have, the more you can lend out and get and earn from interest rate income. So Access Bank is for me a good play in this regard. So I'm looking at Zenith Bank, I'm looking at GTCO, I'm looking at Access Bank. And honorable mention would have been UBA. Because remember, UBA has branches in 20 countries. So we remember what that arbitrage we talked about. Yes. So UBA is also positioned to benefit from that arbitrage. So that's it for the bank. The next sector I will talk about, which people really don't talk about, is insurance. So watch this. Remember, insurance companies do what? They collect premiums. Do you think they sit on cash? Do you think they sit on that cash? There is a time lag between when you collect the premiums and when you do what? When you pay indemnify your clients. So let us say the bank makes the insurance company makes about maybe 1 billion in terms of premiums. Now they have that money to put in. Remember, even when we talk about processing insurance claims, it's not something that it just happens and you start processing and you get it immediately. There's a time lag. That time lag, when in an interest rate environment, I mean, the insurance company they don't sit on cash. Obviously, they put it they invest in fixed. Even if they invest in fixed income, they would have enough to make before they have to attend to indemnification. Now, that is of course if the underwriting discipline is inculcated. Meaning balancing risk, don't going because there are some risks you can take that can literally wipe off everything that you think you have made. So, but insurance companies will benefit from high interest environment. That's why you've even seen some names. Now, for example, I did a buy. I think we talked about when we did that conversation around insurance. I did a buy on custodian investment, and I think it has already done 17% from that point. So. Even more. I have not checked it this morning though, but it has done, as the last time I checked, it had done 17%. So insurance companies are primed to benefit because they accept premiums and which they can use to invest in this and before they actually have to do some payouts. Okay. That's number 4 on the list. Then the next one I think is important is this. I'm going to mention 2, but one is MTN, telecom space, and the other one is Nestle. Nestle for me, I'm coming to MTN, but Nestle for me is because remember, this in high interest rate environment is a two-edged sword. We are talking about just the benefits, but how do you hedge yourself against the downside risk of a high interest rate environment? Remember, in a high interest rate environment, because small businesses are unable to access cheap cash, expansion begins to shrink. Expansion is muted. The economy begins to shrink. Real sector players, that's businesses in the real sector, have less access to cash, so they cannot fund their businesses. You begin to have layoffs. So even purchasing power does what? Reduces. Especially discretionary products. Companies that are selling discretionary products, the stock price begin to do what? To shrink as people's purchasing power diminishes. Now, what that means is that you want to have a defensive in your portfolio. So that's why I'm not pushing Nestle as a prime beneficiary in a high interest environment, but I'm saying it is what will help your portfolio to remain sane, especially if you're exposed to other equities that are highly impacted by high interest rates. So Nestle is a defensive play, but MTN is an offensive play. Why? Because remember, whether it's a high interest environment or not, what you find out is that most people you will have a reduction instead of people to even of some, because when you have less money, if you have more, you have some decent amount of money now, what would you do? If I want to go and see someone, I would go there. I would literally pay my way. But when you have less money in your pocket, what would you do? You realize that you can actually reach the person on WhatsApp.
Yeah.
All of a sudden, you realize all those dates. I'm just using at the very local example.
Have a date online.
So that's the point.
Yeah.
So you have people will lean more towards communication, lean more towards virtual engagements rather than having to spend money. That's why. And MTN also has a very good pricing power, meaning they can translate or push the high interest burden to the customers. So they benefit in an inflationary environment, they benefit from a high interest environment because they can actually push that to the consumers, meaning that their margins will not be compressed. Now, MTN also has a high, look at the numbers. Yeah. They have a high, their operating cash flow is insane, meaning that they are not going to go to the market to think of borrowing at a high interest. Rather, they even have free cash flow that they can actually invest. Because when you talk about cash flow, if you look at the numbers, they have what we call cash in the bank and cash at hand. Yeah. Of course, cash in the bank is not just deposited. They actually invest in government securities and low risk instruments. That also gets them money too. So they have a large, high operating cash flow. Free cash flow is good, so they can invest in some of these securities and make money. So MTN stands. So you have, in summary, you have Zenith Bank, GT Bank, and Access Bank for the banking stocks. Then you have insurance, you have custodian investment. You can also mention name insurance. I also have exposure to name insurance. Then you have MTN, offensive, and then defensive is Nestle.
Now, if you actually want to allocate your resources, how will you do
that? I told you 45 to 50% will go into the banking stock. Then the rest, three, I mentioned three instead of two. The three is custodian investment for insurance sector. I will give that one 20% because I know that then MTN, of course, I will give it 15%. Then Nestle is a defensive, so I'll give it 5%.
All right. Now we'll actually keep looking at these particular stocks and watch how the economy go. The more we see, the more we are going to come out to actually explain. I think by Friday we should have a live session. Friday where we look at the whole.
No, we'll look. A lot of things have happened. Yes. Some companies have started reporting their earnings. So I think
by Friday we're having a very live session where we can actually respond to your live questions on the spot. So join us Friday 4 p.m. Actually have a live session. Thank you for coming.
You're welcome.
And that's our package for today. And please do not forget to like, subscribe, and also put on the notification bell on this channel. Share this content so that others can actually see, direct people to it, and because of the amazing content you actually drop here. My name is Providence, and I'll see you again. Thank you.